America's housing market isn't just slowing down. In 2025, it's in deep freeze. Only 2.8% of U.S. homes have sold this year, an all-time record low, creating a paralyzed market where both buyers and sellers are stuck. The American dream of homeownership, for many, just got put on ice. The U.S. housing market entered 2025 not in a crash, but in a state of total paralysis. Home sales have fallen to their lowest level in over 25 years, with mortgage rates hovering near 7% and homeowners holding on to their properties for a record 11.8 years. It's not a traditional boom and bust cycle. This is a never-before-seen market freeze, transforming the American real estate landscape in ways economists and housing analysts couldn't have predicted just 5 years ago. More than half of U.S. homeowners plan to stay put much longer than expected, thanks to the dramatic jump in mortgage rates. Nearly 52% are locked in, having struck rates of 2 to 3% during the pandemic, and seeing absolutely no reason to give those up for today's 6 to 7%. The average homeowner tenure skyrocketed from 6.5 years in 2008 to nearly 12 years by 2025, a historic high that reflects fundamental changes in how Americans view their homes. In Los Angeles, some owners have stayed put for over 19 years, fueled by property tax incentives under California's Proposition 13 that make moving financially devastating. The lock-in effect has created a situation where 54% of U.S. homeowners say they are not comfortable selling their homes at any mortgage rate in 2025, marking a 12-point increase from the previous year. This reluctance is especially evident among those who currently hold the lowest mortgage rates. According to recent surveys, 41% of homeowners with rates below 3% say they would not contemplate buying again at any rate. Remaining in their homes allows them to maintain housing expenses, typically the most substantial household cost, at a remarkably low level. For the median borrower, a 1 percentage point increase in mortgage rates translates into around $2,000 more in annual mortgage payments, which over the term of the mortgage can amount to an additional $35,000 in future payments. Researchers estimate that the value of the low locked-in rate for the average borrower is about $50,000 in terms of total expected future mortgage payments, taking into account future refinancing in case rates come down. This massive financial cost deters homeowners from selling their homes and moving, even when doing so might otherwise make sense for reasons like employment or lifestyle needs. The median age of homebuyers has jumped from 39 to nearly 59 since 2010, pricing out entire generations and fundamentally reshaping who can participate in the American housing market. Millennials and Gen Z, once expected to drive demand as they entered their prime home-buying years, are struggling to enter the market at all. First-time buyers are now the smallest segment of the market, with most successful buyers being older and relying on substantial equity from previous homes to make purchases possible. This generational shift represents one of the most dramatic demographic changes in American housing history. Only 2.8% of homes are for sale nationwide, a deep freeze never seen before in modern housing market data. Annualized home sales remain stuck at around 4.2 million, far below the pre-pandemic norm of 5 million or more. The gap between current sales volumes and historical averages represents hundreds of thousands of transactions that simply aren't happening, freezing billions of dollars in potential economic activity. In markets like Florida and Texas, inventory is rising but demand is not materializing, while other regions face severe shortages that keep prices elevated despite weakening fundamentals. Sellers are profoundly reluctant to move and lose their ultra-low mortgage rates, creating a situation where the housing stock has effectively been taken off the market by rate differentials alone. Housing inventory is creeping back up in some markets, but it still remains below historical averages nationally. And the inventory that does exist often sits unsold for extended periods. This creates a paradox where inventory appears adequate on paper but doesn't translate into actual transactions because buyers and sellers can't agree on terms that make sense for both parties. 30-year fixed mortgage rates hover around 6.25 to 7% in late 2025, far above the pandemic-era lows that most current homeowners enjoy. Expectations for falling rates haven't materialized as many hoped. Rates actually climbed above 7% in January 2025 before moderating slightly, but they remain elevated enough to keep most potential buyers on the sidelines. Monthly mortgage payments are up to 60% higher than just 4 years ago for the same home, destroying purchasing power across all income brackets. Buyers have been waiting for a price drop or rate decline, but both sides remain frozen in a standoff where nobody wants to make the first move. The typical home is now selling for 1.5% less than the list price, the biggest October discount since 2019, giving buyers more negotiating power than they've had in years. Yet even with this leverage, transaction volumes remain historically depressed because affordability barriers remain too high for most potential buyers to overcome. When excluding those unwilling to buy at any rate, 69% of potential buyers believe mortgage rates must dip below 5% for them to consider purchasing a home. Merely 1% indicate they would feel at ease buying at rates of 6% or higher, illustrating just how dramatically rate sensitivity has changed buyer psychology. This creates a massive expectations gap, where the rates buyers demand are nowhere near where the market actually trades, resulting in continued paralysis. San Francisco bucks the national trend, with sales and prices rebounding while other major cities are stalling or declining. The tech hub's unique economic drivers and constrained geography continue to support demand even as other markets weaken. Florida and Texas are seeing outright deflation, with inventory surging and prices falling in multiple major metros. Jacksonville's median price fell 4%, Dallas dropped 3.6%, and Atlanta declined 2.5% year over year. In Austin, nearly 33% of listings had price cuts in recent months, while the city's median listing price decreased by 4.5% to $524,950. Austin also registered the second greatest inventory increase compared to pre-pandemic levels, at nearly 70%, trailing only Denver. The median sales price for new homes in June 2025 was $401,800, which is 4.9% lower than May 2025 and 2.9% lower than June 2024. The average sales price was $501,000, down from the previous month but slightly higher than a year ago. This points to downward pressure on prices, likely due to rising inventory and decreased demand in key markets. New home sales were at a seasonally adjusted annual rate of $627,000 in June 2025, only 0.6% higher than May 2025, but 6.6% lower than June 2024, indicating a notable year-over-year decline in buying activity. The Northeast remains stable but stagnant, with prices holding but transaction volumes depressed by the same rate dynamics affecting the rest of the country. Some Midwest cities see moderate price growth, but from lower bases and with limited inventory turnover. These diverging regional realities mean there is no single national housing market anymore, just dozens of local markets, each responding to different supply, demand, and economic conditions. Sellers outnumber buyers by roughly 500,000 nationwide. Yet most listings linger unsold, as neither side will budge on terms. The median home sits on the market for 51 days in October 2025, the slowest pace since 2016. This extended time on market reflects fundamental disagreements about valuation, with sellers anchored to recent peak prices and buyers demanding discounts to compensate for higher financing costs. Builders are offering extreme discounts, with incentives of $60,000 or more on new construction just to entice buyers and move inventory. Even with these massive concessions, sales remain sluggish, as buyers remain cautious about committing to what may be the largest financial decision of their lives in an uncertain environment. Single-family housing starts dipped 4.6% in June compared to the previous month and fell 10% from a year earlier, according to 2025 data from the U.S. Census Bureau. Completions declined by 12% month-to-month and 15.5% compared to last year. Builders have been pressured by rising resale inventory and diminishing buyer demand, which is putting downward pressure on new home prices and sales, particularly in regions with a surplus of unsold new homes like Texas and Florida. This construction slowdown will constrain future supply and potentially set up the next cycle of shortages when demand eventually returns. Both sides are waiting for the other to move first, deepening the freeze even more with each passing month. Buyers expect sellers to capitulate on price. Sellers expect rates to fall and restore buyer purchasing power. Neither scenario is materializing quickly enough to break the stalemate. The prospect of refinancing is also unappealing to current homeowners. Only 1% of homeowners report they would consider refinancing at rates of 6% or more, while over half indicate they would not refinance under any circumstances. The majority of American homeowners enjoy mortgage rates below 4%, with some even below 3%. As rates approach 7%, very few are inclined to exchange a 3% rate for a significantly higher one. This isn't 2008 all over again. The crisis of 2025 is fundamentally unique, a structural paralysis brought on by interest rate policy, economic uncertainty, and generational barriers that didn't exist in previous cycles. America's housing market hasn't crashed in the traditional sense of collapsing prices and mass foreclosures. It's frozen, locked in place by rate differentials and affordability barriers that prevent normal market functioning. Until mortgage rates fall substantially, inventory constraints ease, or economic opportunities improve enough to overcome current barriers, the gridlock will remain. The American housing market of 2025 is paralyzed, and nobody knows when the thaw will begin.